China stocks are picking back up today. The Shanghai Composite Index trimmed the losses on speculation that state funds intervened to stabilize the market before the country's celebration of China's role in World War II against Japan. Take a look at the index over the last 6 days, and these are 4 dips that have then moved higher around the same time every day, perhaps waiting for some kind of government intervention. So for a closer look at these politics behind China's stock market, I want to bring in Atlantic Council senior fellow Jamie Metzl, who joins us here in the studio, who did predict a China market bubble bust back in June. Congratulations. Good
for
call.
Whatever it's worth. Thank you.
So when you take a look at that kind of chart where we do see rallies around the same time every day, we do see market intervention. What's your take on that?
Well, it's relatively clear to me, and it is the Chinese government and agents of the Chinese government, including these state-connected brokerage firms, who are all going in to stop this decrease of people selling their shares on the market, because right now China is hell-bent. Am I allowed to say that on this?
Sure.
Okay, good. On not having big losses in their market. And so the government is intervening, but the regular investor who's seen their stocks go down so much and who knows that there's much farther to fall because the stocks are still overvalued, those people would like to get their investments out. And so the government keeps doubling down. And unlike in the United States, where at the time of the crisis, certainly AIG and other companies, the United States government went and bought shares. But we bought at the bottom. The Chinese government is buying at the top. So not only are they intervening in purchasing these overvalued shares, but then the government and all of these brokerage firms are going to be stuck with all of these overvalued shares, and the underlying assets aren't worth what the stock market valuations are currently saying they are. So they're laying the seeds for a lot of big problems. But in the chart that you showed, that's what we're seeing. We're seeing government-related intervention.
So what happens when markets come back on Monday after this World War II celebration? What gives?
Well, again, the Chinese government has a lot of money. And the Chinese stock market is relatively small compared to the size of the overall economy. If China wants to continue along this road of essentially nationalizing their stock markets, they can do that, but they are injecting massive amounts of inefficiency into their economic system. And if their goal is to shift their economy from a command economy into a market economy, which is definitely what they need to do, they're moving in absolutely the wrong direction.
What should they be doing?
What they should be doing, Chinese government has a plan that they've articulated quite well of moving towards a market economy. But to do that, the market needs to find its value. But every time there's a job...
Can they really afford to allow a crash? I mean, what kind of signal would that send to investors and just its own people if what they're doing doesn't actually work and they step back? That's kind of a big no-no.
It's a big no-no because the Chinese government owns the massive increase in the stock market. But they were pushing the increase in the stock market. They were encouraging retail investors to invest. And the reason was they wanted to handle China's big debt problem. And by shifting debt into equity, they wanted to goose consumption, and they wanted to get resources to small and medium-sized enterprises. But once the Chinese government went all in and was encouraging people to buy into the bubble, then they owned that bubble. And when there started to be a correction, which was a very natural correction because the values of the Chinese stocks were just completely out of whack, and then they had to own those valuations, and that's why they've gone in so heavily. Ultimately, they need to, if they want to have a market economy, they have to trust the markets.
What's the risk, though, of not doing anything? And if you take a look inside my Bloomberg terminal, I've charted the Shanghai Composite versus copper prices. They didn't always move in tandem. They just started to this year very intensely. And as the sell-off intensified in the Shanghai Composite, this orange line here is the copper price. Copper got really hammered. The idea is you can't sell a stock in China. You're going to short or sell copper instead.
Right.
So there's a lot of ripple effects in here if the government does not intervene.
Yeah, so it's not do everything or do nothing. The question is, what is the right mix of things to do somewhere in the middle? So they should be decreasing interest rates. I think they're right to lower bank reserve ratio requirements. But to go in and to basically force brokerage firms to start buying overvalued shares, in my mind, that's a really dangerous thing to do. And more broadly, people in China and investors around the world are starting to lose lose faith in the ability of the Chinese government to manage their very complex economy. I mean, they've grown their economy very, very well, but they have one set of instincts of a top-down, authoritarian, semi-market economy. To get to the next phase of Chinese economic growth, they're going to need to let markets do their work a lot more than they're currently comfortable doing.
5-year plans, like coming out in a few weeks, perhaps. So we'll see. All right, thank you so much, Atlantic Council's Jamie Metzl.